Here's an example of a maximum funded indexed universal life insurance policy for a 60-year-old with $2.3 million. Welcome, my name is Daniel McCluskey. I have paid a lot of money to have access to and train under some of the industry's best when it comes to structuring indexed universal life policies. We're going to look at if the financial underwriters allowed 40% of this person's net worth to be used as premium towards an IUL, what it would look like for funding, what it would look like if you wanted to take tax-free income after the funding years, and then 3, what would it look like if he never actually even took income? We have our IUL simulator page here. You can see we have age 60. This is to make it go till age 100. We're going to assume it's growing at a 7% rate. That is before fees, so fees would be after this. And then we put $920,000 as the amount of money going in. That is 2.3 million times 40%, so that's where we're getting that from. Now, if I simulate this IUL, what you'll notice right away is that this number here, the premium for those first 5 years, is actually less than $920,000. So if you multiplied that times 5, that'd be a little bit less. So what that tells me is we need to go up here and change the premium to 6 years. So now that I did that, you can see that there's a little bit of money going in the 6th year. Really quick also, it is important to note this is only hypothetical, does not represent any insurance company or actual IUL product. This is intended for educational use only. Please consult with a licensed professional to acquire an illustration from an insurance company. If this was the case, if the 60-year-old moved over $920,000 over the course of 6 years to comply with the TMR guidelines, you would see if they wanted to start taking tax-free income right away in year 7, that this is the number we're looking at. So that's the $87,849 tax-free, and that continues all the way down until age 100. You can see that. Now, what you might notice right away is up here, I am taking an income of 8% every year. Most people are very familiar with the 4% rule when it comes to withdrawing from 401ks or taxable accounts or accounts in the market. The reason that we're able to take such a higher withdrawal rate for something like an IUL is because, one, we have our floors, so when the market goes down, we're completely protected from those market downturns. We're not going to lose any money due to that. And when we're taking our money out, we're taking that as a tax-free loan. And if we're taking that as a variable loan, which we illustrated here as a 6% rate, but the money's still growing a little above that, we're actually earning a little bit of a spread on money that we're pulling out over the course of the years. So that, coupled with the fact that we have the protection from the market losses, is not only going to provide us all the tax-free benefits, of course, that come with IUL, but it's also going to allow us to actually access and use more of our money while we're living. Now, in this example, I used an 8% withdrawal rate, and you see that after age 100 hits, there's almost no money left. So this is about as high as we could get. To put it a little more conservative, if we put it at 7.5%, you can see here that would be $82,358, and that would leave us much more comfortable into age 100. Now, if you want to see the chart clearly, feel free to pause here in a second when I show you it. What if we never actually took income? What would the growth look like? So let's change that to 0%. So there's no loan balance. You can now see that. And then you can see our accumulated value. That's in this column here. Our surrender value. And then our net death benefit. So if we pass away, that's what transfers tax-free. So you can scroll down, see this continuing to grow. Again, feel free to pause here. And then let's just stop at year 30, for example. So we have our accumulated value here of a little over 4.9 million. And what's important to note, what I mentioned earlier, is we did illustrate this growing at 7%. But there is still our cost of insurance, there is still our fees. So what I did is I went ahead and calculated in a separate tab, what is our net internal rate of return in this situation where we never did pull out? And let's look at that number, because that's the number that really matters. We can say we gained 7%, but what does it really matter if we have our fees? So what I did here is I ran an IRR calculation. It's this formula shown at the top of the screen if you really want to see all that. I imagine you don't. But essentially we plugged in the years that we were funding the policy, then the year that we wanted to check the internal rate of return, and then you start guessing this number here until this number here becomes 0. So you can see, even though we were illustrating at a 7% gain, the net internal rate of return up to that point, that's 30 years in, was 6.23%. That's an example, again, just hypothetical. And if you are wondering, why was it that I was only allowed to put in 40% of this person's net worth with the financial underwriters? Is it possible they would allow more than 40%? The answer is yes, it is possible. It's always going to be case by case, but yes, there is going to be situations where you can get in more than 40%. If you are wondering what kind of tax-free income this would be able to generate you in retirement with this powerful, powerful tool, book a quick consult with me down below, and I look forward to meeting with you. Otherwise, subscribe.